very early. IT index is starting higher. And I think the Nifty heat map will come up on your screen, which will give you a sense of how we are likely to begin on stocks as far as Nifty 50 are concerned. So what do we have? 30 down and 20 odd up. That's basically on the Nifty heat map up on your screen. So 24,315, almost exactly at the 20-day.
Well, in terms of large cap action, autos on the back foot. Remember, the December Vahan registration data shows that the overall registration is down 19%, with two-wheeler registrations down 24%, with stocks like companies like Hero MotoCorp losing market share. Tata Motors, top loser, 1.3% gone. Hero MotoCorp is down close to about 0.8%. Maruti, Bajaj Auto, across the board, auto is on the back foot. Outside of that, in large cap action, it's L&T, ICICI Bank, State Bank of India, Power Grid, which deserves mention. These are stocks with cuts of more than about 0.5% going up to 1%. On the way up, Shriram Finance has bounced back over the last 2 days. Shriram Finance lost more than 5%, so some recouping of losses. Pharma has opened up in the green, so Sun Pharma, Dr. Reddy's, Cipla, again, higher. IT2, marginal gains coming through for Wipro, and ITC, where we're getting closer now to the demerger of the hotel business. ITC adds on. I think ITC was one of the only stocks which closed in the green yesterday, and it's added on another 0.5%.
Well, that's right, Rima. And just take a look at this casualty of this morning is VA Tech Vabag. The stock is down close to around 17%. More than 1,000 crores of market capitalization gets wiped off. I'll tell you what, after they won this order, actually the stock had rallied more than 35%. So now it's given up only half of what it put on, and it's 1,000 crores out of there. I think roughly this project should have given 10% margins, which should have been around 250 crores. Over the next 3 years, around 70 crores per annum. And you give a multiple of around 15 to around 18 times also. That's why that 1,000 crores is what has got shaved off VA Tech Vabag. Sanghi Industries, the ratio is out. It's going to be merged into Ambuja Cements, but the ratio is in favor of Ambuja, not in favor of Sanghi. That's why the stock is down close to 9%. TARC, they're getting into trouble with SEBI. So that's down another 6%. Yesterday as well, it was down circuit limit. You have IRCTC as well. That stock is another one that is a little under the weather. What's doing well? Well, in terms of volumes, you have Edelweiss Financial ended up close to around 8%. Today it's building on some gains. Swiggy, well, the limited free float is having a role to play out there. So that as well is up close to around 2.5%. And 63 Moons moving with very, very large volumes this morning. So Prashant, we're a little bit lower, but I think we're at very, very crucial levels, and the bulls could fancy their chances from here.
Almost like a holding pattern, right? I mean, 24,300 is on the Nifty, which is a short-term daily moving average, which is the 20-day. By the way, the market breadth has flipped a little bit. But again, I mean, just to emphasize, this is early days, more down than up, though, with what we have going at this point in time. Maybe just a few other names before we bring in our market master for the day. Yeah, I mean, there is a fair bit which is starting up, and a lot of stuff which is moving around. Swiggy, of course, you saw that up on the top of your screens, which has been a big performer. So Mazgaon Dock is down about 2%. It's got decent sized volumes on it. Mazgaon ramped up to the top of the volume-led gainers list yesterday. It was a late mover. It's got large volumes, and it's down 2 this morning. Tata Motors is down 2%, 763 on Tata Motors. And it's got very large volumes. Max Healthcare is down about 1.6, so about just under 1,200 rupees on Max Healthcare. Premier Energy is down 2%, about just under 1,300. Only mentioned these are not large price changes, but they've got very large volumes, all of these. So keep an eye. GAIL is starting down about 1.6%. Recent listing, Sagility is down about 1.6 odd percent. There's Garden Reach, which is down about 2% or so at this point in time. So this is, what is down with volumes. Jyoti CNC was a big mover on the upside yesterday. I think ended about 8% higher, and it's up 3% this morning. Second largest volume-led gainer. But this is the first few minutes, so I'm sure things will change. EMS Limited is up 3.5%. Stocks now almost $1,000. I mean, what a runner. You got Coromandel. I think 3% higher, 1866, very large volumes. The crane company, Action Construction Equipment, 2.5%, 3%, 1494 on ACE. Radico is up about 1.2%, 2485. Pokarna, Jindal Saw, Root Mobile, Car Trade, these are all up between 2 and 4% at this stage. So, it's evened out. Market breadth is evened out. The Nifty's moved up into the green. We're about 10 points higher now on the index, 24,350. So holding on at this point. Rana Gupta is with us, Senior Portfolio Manager and India Equity Specialist at Manulife Investment Management. Rana, good to have you with us here. Thank you for your time. I mean, since you have a bird's eye view of what's happening in global markets, what foreign investors are doing, this wait has been has been a long one, right? For foreigners to show some interest. The constant complaint, refrain has been valuations are too high. So I just want to start with that point as we wrap up 24 and head into 25. Will foreigner interest start to reappear? Typically, this allocation happens in the first 20 days or so of January. So that's an important time. How are things looking to your mind?
Sure. Thanks. Good morning. Thanks for having me. I think as far as foreigners are concerned, they, of course, will look at the valuation, the earning growth, and all of those things. But I think when you talk about if we have looked at outflows from India for last couple of months, I think this outflow is not India specific. This is more emerging market because of the US dollar going up and the expectation of US exceptions to continue and so on. But I think as the new year comes, we will see that even in the emerging markets, India still looks one of the best placed markets. I mean, just look at one few of the larger emerging markets, right? China has its own issues to deal with, whether the fiscal stimulus will come or not come. People are waiting, but there is not much clarity how much it will boost growth. Brazil, you have seen what has happened overnight. The fiscal concerns are kind of blowing up there. So I think in the emerging market space, there are a lot of challenges. And within that, India, with its very solid macro, looks very well positioned to receive the emerging market flows that the foreigner is going to make.
I just want to make a quick mention of the flash which is at the bottom of the screen. This is source space information. Remember, the union budget this time is that's 2025 is on a Saturday, which is the 1st of February is a Saturday, and the budget is on a Saturday. And the obvious question is, will markets be trading? And what we learned from sources is that exchanges are going to be discussing this today, and essentially to keep markets open on the union budget day that is on a Saturday. And sources are saying exchanges would like to give investors the opportunity to be able to do something on an important day like the union budget and not just sort of come back on a Monday and then react to what really happens. So it's an important Saturday and the first big domestic event, of course, of 2025. That's the union budget. Nigel.
Yeah, we'll keep an eye out on that as well. Important alert coming in there. And by the way, Prashant, the reason I got bumped is because Travis Head, which has been a big problem for India. Shiraz has sent him back
nice.
So that's 6 wickets down. Our boys are doing well out there. Well, let's get back to the markets. So, hi, Rana. Good morning and good to see you win. Sorry for that. Just need to update our viewers with regard to the cricket match action as well. India is doing quite well out there. But Rana, tell us, top theme for 2025. What are you most bullish on? Reasonable valuations, good outlook. What do you like?
So first of all, I think from a top-down perspective, I think there are reasons to like India is that India is one of the few emerging markets which has got policymakers got enough room without disturbing the macro stability to kind of boost or incentivize growth. So I think from that perspective, we expect government spending to resume for the later part of this financial year, as well as government to reprioritize its spending in the budget when it presented February next year. We also expect, RBI has already cut CRR, injected liquidity, and we also expect RBI to keep doing that and also somewhere in the April, probably to cut rates. With that background in mind, we expect the rural consumption-focused stocks, they have done not really too much, and they look like they are poised for a bounce into the next year. And by saying rural consumption, I really don't mean the consumer staples companies. What we are referring to more like tractor, some select two-wheeler stocks, cement, some construction stocks, so on and so forth. So that's one segment that we like. As the liquidity improves, we also like the large banks, which have struggled for deposit growth. For them, situation will ease at the margin. And as the rates fall, we also like the non-banks, which are into secured lending. So these are the two spaces that we like, and we have always liked digital platforms. But given the run-up that we have seen in stock prices, they could take us some shorter-term pause. And within domestic sector, we continue to like telecom. Among the sectors which are outside focus externally, given IT is a good play on US growth continuing, we continue to large the large cap IT. We also like the pharma CDMO space where the capacities are already available. So I think that sector, irrespective of the Biosecure Act, is going to see pretty strong traction in the years ahead.
Uh, Outside of the non-traditional conventional sectors, Rana, there are lots of ways to now play some of these themes which were not there 2-3 years back in the listed space, and many more are coming because the primary market is so hot. Anything comes to mind which I think one could work with?
Sure, I think one of the historical examples will be the digital space. I think we were bullish on that when this was still a new theme, and now the theme has caught on, and it's now a mainstream theme with new IPOs coming to the market. I think another theme that we like and we can play it in not in the main stock but other ways is the EMS. I think domestic component manufacturing is going to grow. Of course, the listed stocks have had a fantastic run and their valuations are quite high. But you can play the EMS component sector. I mean, some of the component sectors will be going for EMS, will be the CNC machines, will be the glass making companies and all these companies. So I think that is one example that definitely comes to mind.
Rana, EMS companies, you want to narrow down on that one because there is clearly a big runway, but they're coming at very hefty valuations. So if you could narrow down on that theme, what do you like out there? And I guess if you're getting into these themes at these prices, then you must have a longer term view. You can't have a year or so in terms of a time frame because these stocks have seen a very, very sharp run up.
Oh, absolutely. I think, first of all, I think I'm not talking about the EMS mainstream companies, but I'm talking about the component suppliers to them. And definitely their valuation is also not too cheap either. We do see a long-term growth runway till about 2030, and given all the focus on producing more in India, we also see the corporate interests like the US multinationals giving more orders to them, making more in India. In fact, the iPhone shipments from India is really going up. So we like to play that value chain, and we are talking about the components to the EMS spaces like a CNC machines and like glass, the phone glass making and all those things. There the valuation is still high, but given the long-term opportunity, we like that space. Also, I might point out, if I call them EMS ancillaries kind of thing, they are still a lot cheaper than mainstream EMS companies. One can say that these companies, as long as the EMS growth continues, which we think it will, they even can grow at a faster pace than the mainstream EMS companies.
Okay, all right. One more theme I want to discuss with you, Rana, is this entire stock market play. Whether you bought brokerages, exchanges, everything has done well. Now, there is some curbing with regard to trading action by the regulator SEBI. How would you approach this theme? Because you're sitting on big profits out there. Financialization theme in India is likely to pick up pace, but in the near term, that could be a bit of an issue due to the change in regulations.
So that's a very good point. We also like the financialization place because it's again a long-term, structurally very good place to win. But the way to approach it, if one is playing let's say the companies which are exposed to the markets, where their earning is determined by the markets, and there you are getting a lot of volatility, because going forward we expect markets to return moderate returns from here, and the earning estimates are high, the valuations are high. So it could be that if someone is buying brokerages, which are essentially transaction-based revenues, those kind of companies can be exposed to some earning disappointment and maybe some pay disappointment. But having said that, we still like this place. What we like in this place are the companies who have annuity kind of revenues, or as we call it, annual revenue, high retention of clients and annuity revenues. These companies typically will be in the wealth management space. So we like that space. We would like to play that space through wealth management. And these wealth management companies are not necessarily only about mutual fund distribution. They do a lot of products which other financial intermediaries cannot offer. And in India, the top portion of wealth is growing, and demand for those kind of products, sophisticated financial products, is also growing. So we like that space.
By the way, Rana, so many IPOs, right? I mean, most of them, of course, by the time they hit the market, are kind of they're priced aggressively and they further get juiced out on day one and immediately after listing. But sometimes some go under the radar and there's no interest on day one, but they turn out to be big winners. Anything you looked at which seems interesting to you?
Again, I won't be again able to comment on specific names, but you're right. I mean, if you look at the IPOs that are listed, there is one construction company which listed pretty subduedly, but then the interest kind of ramped up. Now, as far as IPO concerned, I think one has to be careful in terms of participating because, as you rightly point out, the valuation comes at a place where it plays out in the first 1-2 days. So best time to participate in IPOs would be when the markets are a little sentiment is a little bad. The IPOs coming there, we have seen that management is also willing to offer reasonable valuation, and those kind of start making money for investors. And recent listing of a digital platform will be a good example of that. But regarding IPO, I think another thing worth mentioning is that one has to be careful about in terms of market fundamentals. The IPOs by the foreign promoters. Foreign promoters, when they are selling stock and taking the money out, this is basically India exporting capital. And the foreign promoters taking this money out, they're not even going to invest back, which can have a bearing for the long-term earning growth for the market as such. So, we hope going forward, we will see some sell downs, and that sell downs will come. Let's be honest about that. But we should see actually reasonable IPOs, reasonable fundraising from the Indian promoters or the foreign promoters who will reinvest back into the company's growth.
No, absolutely. Rana, it's a great chat. Thank you very much for joining us, and thank you for being with us through 24 like in the previous years, and we hope to speak with you in early 25 as well. Thank you very much for joining us. Well, the big listing, or should I say the Vishal listing today, is going to be Vishal Megamart. Mangalam is here to run us through, just the basics, the business, the subscription numbers, the interest from investors, and of course, how it's priced.
Well, Vishal, indeed, the reason why I say that is because it was an 8,000 crore offer for sale by promoters. The issue price at 78 rupees. The two reasons why you expect the listing to be a lot stronger than, what the street would have believed. One is the overall demand for the IPO. While the total subscription was just around 27 times, the QIP portion of which was subscribed by almost 81 times. You had the HNI subscribed by around 14 times and retail by about 2.3 times itself. So there could be a bit of a fear of missing out on the retail and HNI side. And the second thing is they did leave value on the table. One would say at 55 times, how do you define value on the table? Because the other listed peers are all trading anywhere between 80 to 110 times. So to that extent, we would see some sort of up move on the stock at the open itself. And if you were to look at the stock at around 70 times, it would be trading at around 100 rupees, maybe around at 85 times, 120 rupees against the issue price of 78 odd percent. It's a diversified retailer, 645 stores. They do not require cash, have around 700 crores of cash on their books, of which they will use to open 80 to 100 stores per year. The strong moat for them is nearly, 3/4 of their revenue comes in from apparel and general merchandise, and nearly all of that is their own brands, private labels. So as a result of which, they do have strong moat. The only thing that stops them from growing is limited real estate availability or maybe some sort of sentiment downtick in the consumer space itself. They've been compounding at around 24 to 26 times. No reason why the multiple shouldn't be higher than what the issue is offered at.
Brilliant. Thanks a lot for that, Mangalam. But giving you a company today is Vinny, who's here to track Sai Life Sciences, the listing today. Vinny, tell us, what do you expect from that one?
So for the listing today is expected to be a decent listing coming in from Sai Life Sciences, 3,000 crore IPO. It was a part OFS as well as a part fresh issue. Now market cap, that would be at the base price. That's the issue price would be around 11,420 crores. So yes, over and above that, when you look at it, because the PE ratio for FY24, when you calculate it on the basis of FY24 was 137 times, which is much higher than the peers, Indian peers and other CDMO players in India. So look at it in terms of the PE also. When you look at it for something like a Syngene, it's just 81 times. While Sai Life Sciences is 137 times. Then we have TVs at around 88 to 89 times almost in terms of the PE listing. So yes, that is something that is a bit of a concern coming in for analysts because it's a bit more expensive than other players. But nonetheless, the company is involved in a good geography mix. They are mostly into international market. 97% of the revenue comes in from this international market front and 2.6% from the Indian markets. CDMO segment accounts for around 57% of the revenues, while contract research accounts to around 43%. 2-3%. And in terms of revenue also, they have been consistently seeing growth over the last couple of years as well. One interesting thing is in terms of margins, they have jumped up to 20% in the last year. Will be interesting to see because versus peers, it's still lower. So where that moves on, but an interesting listing coming in. We're expecting a decent move in today's trade.
Okay, all right. Thanks a lot for that, Vidi. Well, let's turn our attention then to the healthcare space now. Hospitals and diagnostic space is witnessing an increase in M&A activities. One such company that's exploring strategic opportunities is Narayana Health. To talk about more of this, as well as the business outlook, we have with us Ms. Sandhya, the Group Chief Financial Officer. Hi, Ms. Sandhya. Good morning, and thanks a lot for joining in. Well, tell us about the M&A opportunities that you're looking at. Should we hear about something soon, and what could the potential size be?
Good morning. Thank you for having me here. We've always, whenever we've been asked about M&A, I think as far as India is concerned, we've always been opportunistic about it. And the price of the assets in India are on the higher side, and we really can't deliver the kind of value that we want to deliver to our customers at that price point. So we've been cautious in terms of M&A in India. As far as M&A outside is concerned, again, it is an opportunistic play. We are interested in the Caribbean, and we look at opportunities from time to time. But there is nothing meaningful at this time to share or announce, or there isn't anything that is of significance that we can share at this time.
All right, Ms. Sandhya, so let's talk about more on the macro setup then, with regard to India. I think, various studies suggest that India should be doing roughly around 70 million surgeries, but I think as of now, we're doing half of that. Could you tell us what is the problem? Is it affordability? Is it, how equipped are we technologically? How do we bridge that gap? If you're doing only half of what is required, why is that? And I think as a company, I was going through your annual report as well. Out of the total heart surgeries that are done in India, I think y'all as a group do close to around 15%. Tell us about a little bit more about that as well.
Yes. So there are 2-3 aspects why the industry is not able to catch up to the demand. One, of course, is the availability and access to care. And I think that is solving to a large extent, though a little bit of geographical concentration is there and care is available more at geographical hubs, and people have to travel in from across the country to access care, and that causes a little bit of difficulty. But definitely as a country, we are solving the availability, and over a period of time, we will definitely have enough capacity. The second aspect is affordability. Now, one part of it is solved through government schemes and government programs, which give access to care to the lower end of the spectrum. And the top of the pyramid is anyway have reasonable access to insurance. Really, the people that struggle on affordability are what we call as the missing middle, which is where we as Narayana have launched our missing middle program, where we seek to provide access to care at a very affordable premium. And we believe that more and more such initiatives, with also the insurance, IRDA being far more aggressive in the growth of various insurance products, I think that part will start bridging the affordability part of it. The third part is really people wanting to access care. I think as a country, we are far more conservative in seeking care. For example, if we have a knee pain, we will run as long as possible with the knee pain, but we would not take that knee surgery to solve for the pain. So there is that little resistance to access care as a country, and that I think over a period of time, as people have more and more exposure and they see more and more people getting better results from accessing care, I think that will bridge. Of course, it's a long journey, but we are definitely on the right path.
Right. Sandhya, we're wrapping up. Good morning, Prashant here. We're wrapping up 24, getting into 25. And you always told us, right, that Narayana puts up sort of, surgery-wise cost and et cetera at the start of the year. There's a price hike, it sort of reflects there, and it's clean and out there. So what are you doing now for 25? I mean, on an average across procedures, what kind of price increase are you taking?
So normally our price increases are in low single digits. We don't go beyond that. Mostly we try to cover for inflation. That's exactly the exercise we are going through right now. We are trying to cover for inflation. Inflation is very heavy on the medical side, both wage inflation, equipments inflation, and also in general, medicine consumables. We have seen inflationary trends. So we are trying to cover inflation partially through our own efficiencies, and we are trying to cover partially through price hike. 1st January, we will have our this year, next FY25 price hike, which we will take. And like every year, we will put it up in our website so that it's transparent for everyone.
So would it be sort of high single digits? I mean, just or you think it'll be around the 5-6% level?
Yes, it will be. We're still finalizing that number, but I think it will be in the mid single digits kind of range. We try to keep it lower in that range because that's what is affordable.
And this is blended across the portfolio, right?
Exactly. See, what happens is that in pricing, the insurance contracts are frozen for a period of 2 years. So, which means that when it comes for renewal, that price hike takes effect. And government schemes don't normally do a meaningful price hike at all. So, most of the price hike typically only takes effect immediately for cash patients and for insurance patients whenever the next cycle of renewal for that insurance contract comes.
Okay. All right, Ms. Sandhya, before we let you go, normally we get you post the results and we are very keen on various numbers. But I just wanted to ask you a little bit about robotics because you all are focusing on that aspect. I think you all were gunning for around 10,000 surgeries to be done in a year. You could help me out with that number. How many are you all doing? What is the cost matrix? And if you could tell us what is the path ahead? Because that is one very small right now, but that's a focal point as well.
Yes. So we've invested in robotic capability across our hospitals. At the moment, we have 12 robots. And we have in H1 done about 900 plus robotic surgeries. From the cost part of it, robotics does not bring down the cost of the procedure significantly because there is a consumable cost which comes through. But what robotics does is it brings down the time taken for recovery. So we are able to discharge patients much faster and they are able to also recover much faster. We've had people who've undergone, say, a knee replacement and they're able to walk in a matter of few hours after the surgery. So that's the benefit that we are able to get, and we are very aggressive on our robotics program, and we are working quite a bit in terms of both expanding the program and also expanding the number of people that we are able to touch with the program.
And financially, how does it work? Is it margin accretive? And you said 900 odd surgeries in the first half of the year. By when do you get to that 10,000 mark that you'll have set out in the next 3 years from now? Should it be at that level?
I think it's a good aspiration for us to drive. And from a margin point of view, at the moment, I think it is similar to traditional surgeries only. Mainly because from a pricing point of view, we are not doing a significant premium pricing. We do want to build the demand for robotics. So therefore, I will not call it as a margin accretive item. But then if you look at it, if I'm discharging patients faster, then it improves my throughput. And therefore, I am able to turn around my facility better. And therefore, it does give me benefit indirectly in terms of profitability.
Got it. Okay. All right. Thanks a lot, Ms. Sandhya, for joining in. Wishing you and your team all the very best in 2025. We'll wait for the actual rate in terms of that price increase. But you're doing good work on ground, and we thank you from from all of us here at CNBC-TV18. By the way, Prashant, tracking the match yet again. Australians have thrown in the target over there. They're saying, India, you go bat, you want to chase. I think 280 odd is the target that they have put up. Gutsy declaration, one would have to say. India needs to chase 275 runs. I think we've got around 53 overs. Nail-biting stuff.
Okay, all right. And that's the update. That's the cricket update as we sort of track markets as well. 24,382 is where we're at. We're going to take a quick commercial break here. G Shipping is going to be the next company we speak with on the other side. Stay tuned, coming up. Okay, welcome back. We've got the market, which is up about 35, 40 points. Broader markets are sulking a little bit, but it's that kind of a day. And of course, later today, you've got a big global macro event, which is the last Fed decision for 2024. Well, the shipping industry is in focus next, and we've got one of the largest companies with us, G. Shivkumar, Executive Director and CFO at G Shipping, is now with us to take some questions. And, 25 could be material once Mr. Trump is in office. And depending on what he does, I think consequential for freight rates. Mr. Shivkumar, great to have you with us here. Thank you for your time. At the last you were on with us, you said the Russia-Ukraine conflict and what really happens there is very, very material for freight rates, right? Have we seen any, as we get closer to the inauguration, have we seen any movement in freight rates in anticipation? I'm not sure if freight rates move like stock prices in anticipation, but has there been any movement at all?
Yeah, morning, Prashant. Thanks for having me. No, there hasn't been a movement in anticipation of the inauguration. But freight rates, tanker freight rates in any case have been pretty weak, driven more by market fundamentals than anticipation of geopolitical events. So we've had poor refining margins this year, and they continue to be poor even in this quarter, which means demand for transportation of crude oil has been pretty poor, and so also for refined products. So the market was expecting the normal winter bump in rates. That has not happened, and therefore we've had a pretty weak quarter. So that's been happening, and as I said, it's driven by fundamentals. On the Russia-Ukraine front, we are seeing actions almost every day from the EU, the UK, sanctioning ships that have been in the trade, in the Russian trade, which eventually could have some impact because those ships then get taken out. But that's not going to have a short-term impact, really.
Okay, all right. Hi, good morning, Mr. Shivkumar. Thanks a lot for joining in. Could you quantify the fall? If you compare the spot rate with regard to what we saw, say, in the previous quarter, how much lower are they?
Yeah, so the previous quarter anyway was part of the summer lull, so that would have been pretty low. Let's compare it seasonally, which is a year ago.
Year on year. Perfect. Yes.
Yeah. So product tanker rates, so small product tankers, which is a workhorse of the fleet, 45 to 50,000 ton refined products carriers. They're probably down $15,000 a day from a year ago numbers, $10,000 to $15,000 a day. Crude tankers haven't suffered as much, probably $10,000 a day. So we're talking 25 to 30,000 for product tankers, coming down to maybe around $15,000 a day for the small product tankers. And for the Suezmax crude tankers, which carry 1 million barrels of crude oil, coming down from maybe 45 to 30 to $35,000 a day.
Okay, all right.
So that's across the board about a $10,000 cut year on year, approximately.
Okay, we had a good couple of years, Mr. Shivkumar. Do you think this is the start of a bit of a downtrend? You have warned us in the past that some of these rates that we were seeing may not hold out, and you have cautioned investors as well as our viewers. Do you think we're at a start of a fresh downtrend, or do you think that we're more or less going to stabilize in this sort of a band?
It's tough to call. Rates have been pretty low, so it's surprised most tanker market participants that we've had rates at such low numbers for the last 3 to 4 months.
Yes.
Again, it's down to oil demand, which has been pretty poor. Specifically, transportation fuel demand has been pretty poor. So diesel and petrol, negative growth year on year. So that's a little bit of a concern, whether there's an underlying problem really and whether that will get sorted out. So that's a macro issue really. And of course, you have the EVs, growth in EVs fleets in China. So it could be, but again, the spot market moves with short-term factors. It is, all I say is that it's been weaker than one would have expected. And if the next quarter, because these are the 6 months in which tankers make most of their money, the winter months, and if the next quarter is poor, then I think the market participants will say then maybe this market is over.
And
We've already
70,
seen
80%.
ship prices come off maybe 10 to 15%.
I see. And I think I will just come to that with what you're doing there in terms of purchase of ships, etc., which we've spoken about in the past. 70, 80% of your fleet is spot, right, Mr. Shivkumar? Exposed to
That's
spot.
right.
Yeah.
That's right.
Okay.
70 to 80% of the tanker fleet is spot.
And on rigs, offshore rigs, is there going to be, what's the outlook looking like? I mean, where are these deployed? I mean, in the US, for example, now we are talking about maybe a bit of a boom for the industry, for the oil industry. And I'm not sure whether that will reflect in what way it will reflect in prices, but for the business itself, will that mean anything for you?
Drilling business is very localized. So what happens in the US, and the US will probably be an onshore shale kind of thing. So unlikely to affect offshore to that extent. And in any case, it's a very regional kind of business. In our case, we had a rig which came off contract a month and a half ago. She's got a short-term contract. She'll go on to the contract sometime within the next 3 to 4 weeks. We have another rig coming off contract. We bid into a tender in India. So we'll await what the rates are in the next tender.
But this tender that was cancelled for 2 jackup rigs, with the ONGC, that will impact the second half performance. If you could give us an update on that front?
Not really, because we've got a short-term contract. So we got a short-term contract for the rig which was bid into that, the first rig which was bid into that tender. So at least for the next 4 months, we've got employment. And now there are options to extend it as well. So not a short-term impact. Maybe it could have an impact over maybe the next year or so. But again, there will be more tenders coming through, hopefully.
All right. Mr. Shivkumar, final question before we let you go. In Q2, as you said, that the rates were a little bit softish, seasonally weak as well. But the NAVs were maintained. That's because some of these contracts are already longer term, so you're already enjoying the benefits of higher rates there, and you're throwing up cash as well. So NAVs didn't come down. Do you expect more of the same, say in Q3, Q4, because some of them are locked up, you're throwing up cash as well, so NAVs will not dip?
So in the previous quarter, while rates were weak, people were still, and especially in tankers, which form a majority of our fleet, participants were still expecting rates to recover during the winter. So prices of ships didn't really come down, especially not for tankers. Now they've started to come down, so you will not have that impact, meaning you will, so that will definitely pressure the net asset value in this quarter to some extent. Not a huge extent because we're talking 10 to 15%, but to some extent that will have an impact.
Okay, Mr. Shivkumar, we'll leave it there, sir. Thank you for joining us as we wind down 24 and see you in the new year. And thanks very much. So that's G Shipping with the perspective on the business and outlook for the company as well. Well, on the regulatory front, there is a fair bit happening as well. SEBI has proposed algorithmic trading for retail investors with additional safeguards. SEBI has submitted a consultation paper on the same and has sought comments from the public by the 3rd of January. We have Rajesh Baheti, Managing Director at Cross Seas Capital Services, and Tejas Khode, Co-founder and CEO at Fires, now joining in. Tejas and Rajesh, great to have both of you here. Thank you for joining in. Rajesh, so just to put this in context, I mean, is this to safeguard, is this to kind of frame regulations around a new segment which is opening up for retail, or is it to kind of put in guardrails for a lot of the offerings which are already there? Because I suppose it's the latter. A lot of these offerings are already there for retail investors, right? For a certain fee, you can get access to these programs, and I mean, it's been on for years. So just wanted your thoughts, Rajesh.
Yeah, so it's not a permission for retail to do algo trading. They were already doing it. It's actually a guardrail. You're absolutely right. What was happening currently was that there were these marketplaces that were displaying algos from independent algo providers. They had connectivity established to maybe 10, 15 brokers. So you could choose your algo provider. You could choose your broker. These brokers had given their APIs out to these marketplaces as well as to anybody who wanted to develop an algo. And then you were connecting to one of these brokers, but these trades were not getting reflected on the exchange system as an algo trade. They were just simply being reflected as an internet-based trade. So what SEBI has said that you cannot simply expose your API now and have these people log in and do that automation. And you cannot call this an internet-based trade. Each and every algo has to be identified as an algo trade, and permission has to be taken from the exchange. The algo has to be approved, and the algo providers also simply cannot lend their algos out to the public. Just like that, they have to be registered as investment advisors. So it's being made much tougher now for people to simply offer their algos because they have to be registered as investment advisors. And if you make your own algo, you can only do it for your own family, and you can't simply farm it out to other people.
Nadi, okay, that's interesting. Because the way I said it, I read a couple of reports which basically said it's kind of to level the playing field. Institutional investors have access. Why shouldn't retail? But what I'm hearing from you, Rajesh, is actually, if anything, it'll make things tighter in terms of access to these algos. It's the opposite.
Yes. Currently, a lot of retail algo was being represented as an internet-based trade and not technically an algo trade. So you could argue technically a lot of this will move into algo trading, and therefore you can say that retail is doing algo. But all this is just simply change of nomenclature with a lot of conditions.
Tejas, your first thoughts on the subject?
Hey, Prashant. Yeah, so Rajesh is on the right track. I feel like it's going to be more compliance-oriented, operationally cumbersome, especially for brokers and the traders, because algo trading is all about iterating strategies on the go as well. It's not as though you create a strategy and run it all year round. That's not how it works. So there is still no clarity about if every iteration needs approval, especially if it's a black box strategy. So it's something to wait and watch for. We are going to give our detailed feedback to the regulator about this. But largely, like Rajesh said, algo traders are already doing what they need to do, right? Algo trading is already democratized, and we have been at the forefront providing these services. But from a regulatory standpoint, I think what they are doing is trying to increase the span of control and making the buck stop with the broker, because they are the regulated entities. And I see long-term benefits to this, like I always do. And it's ultimately going to help expand the ecosystem, albeit at a gradual pace.
Okay. Rajesh, you said that trades were not getting reflected as algo trades at the exchange, at the exchange level. I mean, a trade is a trade, I would imagine, right? Why is that? How is that different, and why should it be? What's the reason?
Well, one of the reasons could be that if you run black box strategies, you could have a situation where there's a runaway loop that an algo creates. There could be coding errors. And what exchanges need to understand is if some of that is happening, or if there are any algos that are detrimental to the integrity of the market. And if these trades simply get reflected as an internet-based trade, it looks like a manual trade. And you've got to be careful when you run algos in terms of risk management, because these are automated systems. And if there's one coding error, it's likely to get repeated over and over again in a loop. So from that point of view, reflecting it as an algo trade also for understanding how the market is evolving. I think data gets collected on, what percentage of trades are algo, what percentage is institutional, blah, blah, blah. So from that point of view, also, it is not a bad idea to identify them as an algo trade. But I think the problem, as my co-participant has just said, is that algos are not static instruments. You really ought to, if you want to survive in this market, there is a change needed maybe every day, every week. And you've got to tweak your strategies, go back and backtest them every evening with the new data coming in. And to say that every time you change a parameter, you've got to go back to the exchange is simply saying that, you've got to eat a stale apple every day, because you've got to make a fresh one and you've got to put it in the market out there. So I think that's the problem area. Let's see how that gets sorted out.
The iteration bit, which Tejas also referred to. By the way, the three listings are up on your screen. Vishal Mega Mart, 36% odd. I mean, it listed, I think, with a 50% premium on top of the issue price. Sai Life Sciences, that's a 21 odd % pop on top of the issue price. And you got MobiKwik. They cut down their valuations by basically down to 1/4. And the stock's jumping, and how? 75% on MobiKwik. So $490 coming through there. So that's a rich screen. Primary markets are red hot, and more companies, interesting companies from different sectors, older sectors, conventional sectors, are coming to the market. You'll hear, by the way, we've already spoken with the three managements over the last couple of weeks as the issue opened, and you'll hear from all of them later through the course of the day on day one. So from Vishal, from MobiKwik and Sai Life Sciences, and hopefully you'll get some sort of, forward-looking numbers, etc. as well in terms of what growth expectations, etc. are. So those are the new listings out there. Tejas, just in terms of your platform, is there any way to quantify how much of the volume is, or maybe even for the broader market, if you have a number, how much of this is retail algo volume?
Very small currently. Discretionary trading dominates retail volumes. At Fires, it's in the single digit percentages in terms of the number of clients that participate using algos. If you've read the white paper, right, the regulations that are being proposed by SEBI are, I would say, positive in the long term. But in the short term, it's going to create so many hassles. It's one thing to identify a trade as an algo, which is required from a regulatory standpoint. It could cause loops, it could cause flash crashes, very unlikely for retail. But I'd say it's definitely positive, and it's a growing sector. I think it should grow much more because these days people don't really have the time to trade during office hours, right? They're either stuck in traffic, in meetings, and whatnot. So automating trades is the way of the future, and we should not resist it too much because it will stall the evolution of stock markets, in my opinion. And it also helps, right? Because retail traders are able to control their risks much better and trade in a more objective, less emotional manner. And that is actually a desired outcome for all stakeholders.
All right, we'll continue this chat, and once the sort of rules come into effect. Right now, of course, it's a consultation paper open for comments till the 3rd of January. Rajesh and Tejas, good speaking with you. Thank you very much for joining us as we look at this issue. Well, look at the market, which has taken a big turn. We were up about, I think, 30 points. We are down 60 on the Nifty. So this is a bit of a turn which has come through in the last couple of minutes or so. And maybe just a quick look at what is really causing this before we go any further. On the Nifty, which are the biggest drags actually? So HDFC Bank, ICICI Bank, 22 points from HDFC Bank and about 18 points from ICICI Bank. These are the two biggest drags. So banks yesterday were a problem point. And I think this morning, once again, you've got a bit of a drag coming through. On the other side of the equation, of course, you got Reliance pulling its weight a little bit. So 1252 on Reliance, about 10-11 index points. And you've got a bunch of pharma and IT names, Sun, Dr. Reddy's, HCL Tech, which are also pulling in the positive green direction. We'll take a quick commercial break here. We'll come back, more stocks in focus, commodities with Manisha as well. Stay tuned. Okay, welcome back. 90 lower now on the Nifty. So, the direction is down, not up. It was up briefly, but all that's been given up and we're at the day's lowest point now. What's happening in commodities, though? Manisha is standing by with that bit. Manisha, good morning.
Morning, Prashant. Well, I'm going to talk about those commodities which matter the most as we have holidays coming in. And, well, it's not good news because when you look at the cocoa and the coffee prices, well, they are trading near all-time highs. I'll start with cocoa first, and these are the all-time highest prices that you have seen at $11,900 a ton. The prices have gained up quite strongly in this year. Until now, we are up by nearly 185 percentage point. Well, it has to do with the rising cost, and that has impacted the downstream companies. There are various reports suggesting on how the chocolate companies, dessert companies and cake prices have gone up in this year. And the final week or 10 days of this year could be looking at higher prices as well. The gains come in on the back of global cocoa markets facing their worst or the biggest deficit in 60 years and for the 2023-24. And the current year also is expected to be on a deficit side here. The global markets are facing this deficit for a third straight year, and the next year isn't expected to be any better. Well, it has been about crop failures in the major producers like Ivory Coast and Ghana, the crop diseases, aging trees. The newer trees will take time before they start productivity. And then it also has been about lower wages to farmers. So the sector clearly seems to be staring at various concerns there. If you look at the ICE, and that is where the global prices really get firm on the US ports, the inventories are at an 18-month lows. Also, when you look at the inventories, they are at a 20-year lows on ICE itself at around 38,000 bags there. The markets also are looking at the International Cocoa Organization report, which says that the next year the crop prospects seem better, but the higher prices for the retail perhaps could still be a reality. Take a look at the coffee prices, and we have seen very strong gains come in for that one at multi-decade highs for coffee prices also. So when you look at the prices in this year itself, we have seen strong fundamentals, speculative positions on the higher side, and the Arabica and Robusta prices have seen very strong gains as well. So 70% up for Arabica and 90% up for Robusta prices is how coffee is also trading at. The only respite clearly comes in case of sugar prices, which have seen 4% of a decline overnight. And with that, sugar is now trading at around 3-month lows. Well, the global supply outlook has improved from Brazil, from India and from Thailand as well, which is bringing the prices down. The Brazil crushing in the second half of November actually has been on the higher side. And the markets also are looking at the USDA report, which says that we are looking at sugar consumption and production higher in this year. If you look at the sugar prices in this year until now, we are down by 4%. So only respite when it comes to sweets and desserts and chocolates during Christmas and holidays comes in from sugar, because cocoa and coffee prices are trading at an all-time highs.
All right, Manisha, thank you very much for that. So that's commodities in focus. Shopper Stop is the next one we want to focus on. Back to stocks. Nimesh is standing by to tell us why. Nimesh, morning.
Morning, Prashant. So we just flashed the exclusives on Shopper Stop. There's a large block in Shopper Stop in the pre-open trade today. I understand Amazon, who owns 4% stake, has completely sold out its entire stake in Shopper Stop today via block deal. In terms of buyers, it was largely dominated by DIs, but I understand some FIs have also bought in today's block. So no hedges. It was purely long onlys who've bought in today's block deal. If you look at the shareholding pattern, it's quite interesting. The promoters on 65%. The institution within institutions, it's largely owned by mutual funds. They own close to 22% stake in Shopper Stop, and FIs own close to 7%. Just for records, Amazon bought the 5% stake in Shopper Stop way back in 2017, and now they've sold out completely. They haven't made much money out of it. They invested close to 180 crores, and now for the 4% stake, they've garnered close to 280 crores. So not much gains as far as their stake is concerned. But for records, it's a clean out trade. Amazon has completely sold out its entire 4% stake in Shopper Stop via block deal today.
All right, thank you very much, Nimesh, for that. That's exclusive information. And that's an interesting one as well. Stocks up about 2.33%. Clean out trade in Shoppers 642. Well, we'll take a quick commercial break here, but on the other side, it's our special segment. It's the economy. My colleague Latha will be speaking with HDFC Bank economist Sakshi Gupta and IDFC Bank's Paritosh Mathur on the impact of the rising trade deficit on the Indian rupee. Stay tuned. That's coming up.
Welcome to It's the Economy. The rupee has depreciated by 0.5% this month and by 2.7% this quarter, that is from October. And it looks poised to touch the 85 rupees per dollar mark. While foreign portfolio investment sales, as you can see on your chart, have been very strong in the past week, the latest piece of bad news to hit the rupee is the November trade data. The deficit has come in at an all-time monthly high of $20 billion if you count goods and services, and an all-time high of $38 billion if you only count goods deficit. The rupee is still one of the better performing currencies in Asia, but it is, if you looked at only the month-to-date data, it has slipped a little more than it was slipping quarter-to-date. So is the trade balance data and other probably, slower growth in Q3 likely to lead to more dollar purchases and rupee sales? I have with me two experts to discuss the trajectory of the rupee. Paritosh Mathur, the head wholesale banking from IDFC First Bank, and Sakshi Gupta, economist from HDFC Bank. Paritosh, Sakshi, thank you very much indeed for sparing time for me. Sakshi, first to you. This trade deficit data coming at a monthly all-time high, whether you took services and goods or only goods, is that likely to worsen? Are you going to see even more deficits, and are you changing your current account deficit forecasts?
Right, Lata. So this month's November trade deficit number was clearly very, very weak. But, when we are looking at the trade data, we also have to firstly remember that, there's a huge seasonal component that plays out in Q3, right? So you have the festive season, which leads to an increase in gold demands. Gold demand volumes went up, for the November data, and that was the reason why our gold imports were significantly higher. Also, November is usually a slow month in terms of exports, but they usually tend to recover a little bit in the month of December as you have, the holiday season in the West. So, clearly one way to look at this data is that, yes, there is some amount of seasonal, component here. But even if I kind of correct for all this seasonality, clearly there is a pressure building up on our trade deficit and consequently on the current account. I think we are going to see export growth continuing to slow down as we move forward in the coming months, particularly as major trading partners like Europe and China continue to see slower growth. So there are headwinds coming from the external front. In terms of, our import basket, while, oil prices have been broadly contained for now, they still continue to remain elevated. So we haven't seen a sustained fall in oil prices as of yet. And on the gold front, I think given the continued, uncertainty globally, both on account of, Mr. Trump coming and taking power in the US and the geopolitical tensions that continue to kind of simmer on, gold prices are expected to remain elevated. So, the sense that we are getting on the current account and our trade situation clearly is that, we are looking at a print of 1.5% of GDP for the current account deficit for this, fiscal year. I think I just want to mention one thing.
Sakshi, the point I'm driving at is, have your numbers deteriorated after seeing the November data?
No, absolutely.
Were you at 1.1 and you went to 1.5% CAD? Because some of the economists have increased their current account deficit expectations after seeing the data.
Absolutely, Lata. So we were at 1.2% in terms of our current account deficit, and we've raised that to 1.5. As I said, that this is coming on the back of that. Even if I make adjustments to the seasonality that we see in this data, the weakness clearly has been much more than what we would have witnessed.
Okay. Paritosh, if I may toss that to you, we were pointing out, the FII sales data would come both month-wise as well as day-wise for the last 5 days, for the last 5 months. It has been showing increased selling. But has the mood deteriorated after the current account the trade deficit number? Sorry.
Hi, good morning, Lata.
Look, I think the overall dollar demand has been sort of increasing through the months of October and November, more so in November. And frankly, the trade deficit data is, I would think, a corroboration or a confirmation of the fact that there's been dollar demand going on, and it's just telling you that where the dollar demand was actually coming from. Therefore, it's it's data in the rear view. It does not imply that therefore going forward immediately there should be either a large depreciation experience on INR or that the flows would suddenly start to pick up and see more dollar demand because
just
of the trade deficit.
1 minute, Paritosh. I take your point entirely that the trade deficit was lagged data, and you all must have seen that demand in November. It's not something that's happening today, but it can sour sentiment is what I'm asking. Would people think that, oh, we are going to head into greater purchases of dollars because our imports are going to be higher than our exports even for the coming months? Is it leading to people buying dollars forward, importers or whoever?
I think not. And I say so because, like Sakshi also pointed out, the specific extraordinary dollar demand that we saw in November could be attributed also to the large gems and jewelry buying, gold and jewelry buying that's taken place. You could consider that for the festive season, marriage seasons, etc. And also, obviously, the customs duty cut that took place in July, August is further boosting demand for gold. So if you take out the gold component from the trade deficit number, it's a moderate increase. It's not a very dramatic increase that should fundamentally make us believe that trade deficit of this order is here to stay on a month-on-month basis. So we would right now be inclined to believe that trade deficit would sort of settle back into a 25 to 28, $29 billion range. Probably not go back all the way to $22 billion range, but could settle back into a 25 to 28 billion dollars range, and therefore overall deficit of a 1.3 to 1.4%, maybe 1.5% is potentially the outcome for the full financial year.
Okay. No, I'm worrying only because we have never seen 15 billion. The highest we last saw was $10 billion of gold imports in the month of August. So I'm just worrying that we may not go, will we go back to that $3 to $5 billion? And I don't know if, it can fall that much. Will it be a new low or rather a new normal in terms of higher deficit? Paritosh, no fears like that in the market?
I don't think that market is currently believing that, this trade deficit number is going to be sticking around and the gold buying is going to be sustained at these levels.
Okay. No, not at these levels. I'm just wondering if it's a new high. The other question I wanted to ask you is, therefore, how are you looking at the dollar rupee? Your year-end forecast, and if possible, a Jan-Feb forecast. I know it's difficult because when President Trump comes in, it's a binary event. It's not like a business as usual event. But nevertheless, your forecast for December end and possibly quarter end, March quarter.
So I think what we've been experiencing is largely a gradual depreciation in rupee, and fairly well managed, both in terms of the usage of reserves for supporting rupee at various points in time, literally a daily activity that's going on there. And given that I mentioned that I do expect at least the trade deficit to start correcting back from this type of a peak that we saw in November. Yes, the rupee should and will continue to depreciate, and there's nothing wrong with it crossing a 85 mark between now and say 31st of December. But yeah, we could as well think that it can hover around any levels now. It's very difficult to actually predict a very short-term view on it, but 84.90 to a 85.10-15 kind of range is something where dollar rupee could end for December.
And for 2025,
yeah. So if we project out over Q4 is normally a good quarter from a balance of payments positioning. We normally do get a positive BOP play out, at least seasonally, each quarter, each fourth quarter. We've witnessed that over the past many years, and so keeping that, keeping that as the base of thought process still. Rupee would still depreciate because of various global factors, like you pointed out, Trump's administration, President Trump's administration coming in.
Yeah, so your range is, I'm out of time, Paritosh, so what's your range?
So I would think, if we end Feb, March somewhere between 85, 40, 50, it should be good.
Within the range of expectation. Sakshi, very quickly, sorry, out of time. The Vahan data that my colleague presented is also quite terrible for the month of December. And it is year on year. So there's no point saying that December people don't buy vehicles because we are comparing December over December. So does that reduce the expectations of Q3 growth as well? And could not that exacerbate foreign selling?
No, Lata, we actually have a lot of the data that we track on the economy has been very, very mixed so far. So it is not like you are getting a, unanimous increase or improvement in activity, including the Vahan data that you are talking about, right? So we would expect GDP growth right now for the third quarter to be somewhere close to 6.5, 6.6. That is where we are tracking the data to be, which is more than where the RBI is. And for the annual number as well, we are lower than the RBI's projection at 6.4 right now. But I think the bottom line on the growth data is that while there has been this expectation of pickup in economic activity in the second half of the year, the data has been much more mixed and uneven in that regard.
All right. I'm sorry, I'm rushing you all because I'm out of time and there are a lot of IPOs that are getting listed and we are very keen to listen to those managements as well. Paritosh, Sakshi, thank you very much for joining us with your discussion on the rupee. Rupee slightly weaker, 84.93. We wrap up on Bazaar. Chartbusters coming.
Ambuja Cements announces an amalgamation of its subsidiaries Sanghi Industries and Penna Cement with itself. Street sees the merger in favour of Ambuja and negative for Sanghi as the swap ratio values the latter at a discount. Sanghi, as a result of which, down 10%.
Vatek Vabag tanks in trade after a 2,700 crore order from the Saudi Water Authority gets cancelled.
Shoppers Stop climbs in trade today after nearly 3.5% equity worth 236 crore rupees changes hands at 628 rupees a piece in a block deal window. Sources tell CNBC-TV18 that Amazon.com is the likely seller in a clean-out trade.
Vishal Mega Mart has good listing, list at around 104 rupees per share versus its issue price of 78 rupees. To talk about the listing and the company's future plans, we'll be joined by Mr. Kapoor, the MD and CEO.
It's a day of bunch of listings. MobiKwik and Sai Life Sciences too listed a premium against their issue prices. MobiKwik lists at around 440 rupees per share against its issue price of 279. Holds about that 505 rupees mark. The other one, Sai Life Sciences as well, lists at around 650 rupees versus its issue price of 550. Currently, the stock above that 710 mark. But you don't go anywhere because very shortly, Upasana Taku, who is the chairperson and CFO of MobiKwik, will join us to discuss the company's post-listing plans.
Hello, welcome to Chartbusters. I'm Nigel. With me is Mangalam. It's IPOs today that are center stage. We have 3 IPOs that listed. All 3 of them, if you got allotted, you'll be very, very happy because all of them have seen a blockbuster listing. For the Nifty, well, it's down close to around 50 points at one point of time today. It was up close to around 50 points. I think the sense you get is, at lower levels, we should see some buying. 24,200, well, that's the mark from when we have bounced in the past. Today as well, we almost went to those levels. So keep an eye on that. And the Nifty Bank, that's at a very, very crucial juncture. In 2 sessions, that index has lost more than 1,000 points. So I think it's due as well for a bit of a bounce. It's taken support at lower levels. Let's see how this goes, Mangalam.
A bounce is due, Nigel. We'll keep an eye out on that. Largely because, one, we have seen a bit of a sell-off. Secondly, we have the options expiry tomorrow. The put-call ratio at around that 0.64 mark. Also at the lower end of the range. We'll watch out for whether there is an upside coming in on that one or not. And the Nifty around that 20-day moving average. But most importantly, just keep an eye out on Reliance. The big index heavyweight currently is now moving higher, currently around the higher end of today's trading range with a gain of 1%. If that continues to support the frontline index, then maybe we will see a bit of an uptick. But let's kick off the show with a new listing on the bourses. Payment platform One MobiKwik saw a strong debut on listing. What we'll do is take a short break, come back. On the other side, the management, Upasana Taku, the executive director and chairperson, along with the CFO of the company, joins in to discuss the company's post-listing strategies and future itself. And as we take that short break, also get the idea of a profit coming in from our Money Control Pro colleagues. Bharat Jinani joins in. Bharat Jinani talks about that idea for profit, take a short break, and on the other side, we have the management of MobiKwik.
The demand momentum continues to remain strong across the verticals, that is business, leisure, meetings and conferences. With the upcoming wedding and the holiday